March now, China's September trade surplus is in at almost $17 billion. It's slightly down on the $20 billion plus we've seen over the past 3 months, but the result caps China's biggest quarterly excess since the financial crisis. So what does it mean for the yuan and China's trade relations? Let's ask Tao Wang, the head of China economic research at UBS in Beijing. Thanks very much for speaking to us. So we're talking almost $17 billion, what, 16.9 to be precise, billion-dollar trade surplus for China in September. Your initial thoughts on this figure?
Well, this is very much in line with what we have been expecting. I think a few months ago, we saw exports continue to be very strong while imports have already decelerated. So we saw a bit of a, very large increase in trade surplus, but that's probably temporary. In the next few months, we will still see very sizable trade surplus in the range of 15 to 20 billion or so a month. So for the year, we're looking at close to 180 billion, slightly lower than last year. The implication for the RMB, not that much. I think the government has made it clear that it sees only a small room for RMB adjustment, and that's what we will get.
Many would argue that China's currency, that these figures show that China's currency isn't strengthening fast enough. Would you agree?
Well, I think I'm one of the people who would agree that the currency seems to be undervalued. Of course, by how much is subject to serious debate. Right now, the Chinese government had made a speech, the central bank deputy governor made a speech that the government would like to see current account surplus to go down to about 4% of GDP. Right now, we're looking at 5.5% to 6%. So their argument is that there's not a huge amount of room from that point of view. I would think in the next few months we will see a more visible appreciation of RMB against the dollar. So we're looking at the rate trading at 6.55 or so by year end.
But is the trade surplus just about the currency issue? What other structural dynamics are at play here?
Exactly. That's a wonderful question, because it is not just about exchange rate. It's just a flashpoint that everybody grabs on. It's really a reflection of structural imbalances both in China as well as in some of its large trading partners such as the U.S. In China itself, I think China needs to embark on some more fundamental reforms to promote domestic demand, such as increasing wages, deregulate the service sector, promote private investment, not just the tradable goods, raise the energy and resource prices, charge environmental costs, and so on and so forth. I think these actually matters probably more than the nominal exchange rate.
And are we seeing evidence of tangible action in that direction by the Chinese government to implement those reforms?
Well, those reforms are quite difficult. We certainly have seen a lot of intention and plans being announced, specifically about expand the coverage of pension and healthcare, raising minimum wage, trying to divert or guide growth to inland regions and so on. We have seen some progress, but it takes time. And some of the reforms, of course, will touch upon vested interests as well. So politically will be also difficult.
Okay, thank you very much indeed, Tao Wang, head of China economic research at UBS. Good to get your thoughts.